Just on the same question, Charles, you're seeing a shift. We're seeing a very interesting shift in the space. As of last year, we've seen the bank deposit for the first time decline from around 5.9 trillion to 5.6 trillion as of Q3 numbers. And we're seeing also, as the shift is happening on the banking side, we're seeing the CIS space is growing. So where is the market overconfident?
Yeah, it's an interesting question. What we've seen is the CIS space, which is a collective investment scheme, basically the unit trust space, has grown significantly. I think it's exponentially grown from 2018, 2019, since that particular period. Over the 6 years, we've seen phenomenal growth. And I think a lot of factors, Moses has touched on it, is investor knowledge has picked up significantly. And so investors are aware now that I don't have to just keep my money in the bank. I can actually earn a better return with the same risk and better liquidity, for example, with a money market account compared to a fixed deposit. And not only that is the fact that we've seen many fund managers come into the space. We have seen those fund managers, come into the space, educate, like how Nabo Capital does, educate the masses about investments, and now they've become more knowledgeable. And we've seen now that liquidity transfer, and we're seeing it now in massive volumes. As the fund management space is growing billions every quarter. And so if we look at overconfidence, I wouldn't say even the market is overconfident. I think it's going in the right direction. This is a market that has a bright future because now investments are becoming, going beyond the typical Kenyan way of either I have money in my bank or I have a land in Kamulu. And it's not to say that if you have land in Kamulu, it's bad. It's okay. Don't worry, you're okay. But now you're understanding that investments can serve a purpose, which is earn you money. We say investments is something that can earn you money while you sleep. And that's, like, say, the work of Moses to ensure that his clients, let's say when they retire, they don't have to work anymore and they can comfortably live a good life while their money works for them. And so we're seeing that mind shift, and especially something that I've noted is the younger generation. The younger generation, the Gen Zs, are quite aware of, as soon as they're 18, you're seeing them invest in money market funds. We've seen that with our own clients. We have young clients as young as 18 investing in money market funds. So I think that is the direction we'll continue to see with more marketing, with more awareness, and that market will continue to grow as well. So the confidence, I think, is not too overconfident. I think the market is in the right place at the right time right now.
Just a follow-up question on that. Do you think special fund is one product that investors have high confidence on?
Yeah, that's a good question, in the fact that right now the hype is special funds. And just to give, for those maybe who might not be aware, so there's a categorization that was made by the CMA from the CIS 2023 regulations. So what is a special fund? A special fund is any fund that can allocate assets defined by the company itself. So you define your strategy, right? So your strategy could be, for example, offshore strategy, where you're saying, let's say a fund manager comes and says, I want to invest in US equities or US stocks, and that's now my strategy. So I apply a license that I submit to CMA saying specifically this fund will be a special fund that invests in US equities or US stocks. Now, once you get that license, you become a special fund. So we've seen now special funds in different categories, others doing multi-asset, meaning they can invest in different type of assets, fixed income, equities all together, pure equities, pure fixed income, dollar types. So that's what a special fund is. And the reason why they've grown so much is because of the appetite for returns. Some of them have been giving returns upwards of 16, 18% consistently over a period of time. I think the market is shifting there because of the returns, but I think as Moses had made it aware, it should not be just a return only look. It should be a factor of looking at returns and risk. Okay. But the most important part, it should be understanding what you're investing in. A lot of people don't understand what they're investing in. They're just chasing the return alone. They are chasing a 16 and 18%. But if you ask them, what is this 18%? How is it generated? No clue. So it's an urge to all investors, to anyone who wants to invest, not just in special funds, but any type of investment where you put your hard-earned money, to understand it. That's your first. And also understanding the risk, because we say in the field of finance, there's no free lunch. And so if you're seeing a free lunch, think twice. So I'd say that all these funds that are coming, they're good, but for the investors, just please understand where you're putting your money. And once you understand it and you're willing to take that risk, then you can be comfortable deploying with that in mind.
Okay. Thank you, Charles. I'll come back to you, Moses, now. Charles has talked of many things. I've picked a few. First, there's no free lunch. So if someone asks you for free lunch, be sure to pay for that lunch. So Charles has mentioned you have to have a defined strategy. And my question is, do you think investors, our current investors, are they investing strategically, or it's emotionally driven kind of investment?
Thank you. And actually, first is to add on what he mentioned about the return. Return, as you mentioned it, and anyone is pursuing to get a return, there are other factors. Things like peace of mind. You know, if you invested somewhere, I could be getting 20%, but I'm not sleeping. I'm not able to sleep. I'm just worried what is happening. The other thing is the liquidity. In case I'm in this, what is the ease of exit? Yes, I could be getting the 20% or the 40%, but what is the ease of exit? You know, so those are some of the factors you look at. Of course, things like opportunity cost. This money I could have invested somewhere else. So all these factors, the return you are taking should be able to kind of compensate on all these factors. And that's why you say the higher the risk, the higher the return you should demand to compensate for that opportunity cost you are taking. So maybe you're training your peace of mind with this. So when you look at it on the investors and the trend in the market, I would say we've been a reactive market. Reactive investors, emotional investors, you know, whereby we just hear, and this is something we call hard effect, whereby we hear this is where the return is made. We run there without even doing our due diligence. Just because I heard somebody is doing it, I just go. And if something happens, of course, I'll start blaming. And even people will invest in an asset class, even when they have not checked, is this even a regulated asset class by the Capital Market Authority? Because that's where you start. So the first thing, you ensure that you have done your due diligence, understand it, but the current situation we have with investors, which I've seen and I've interacted with them and I've been educating most of the client, most of them, if you look at the percentage, almost 80%, they are seeking the return. And some of them following a pattern in the market, following other investors or information, you know, and that's why you hear in our market when something comes, people lose money. Maybe something came in packaged like an investment, people lost money. And when I have one-on-one discussion with the client, sometimes people come wounded from somewhere else. Somebody lost money that was meant for maybe for the family just as something was packaged as an investment. They were told this is the thing, this will make you money for you. As what Charles has said, there's no free lunch, or if somebody tells you you can double your money within a year or triple and all that, those are some of the information people are sold. But what I tell my client is go beyond the return, go beyond making money, and is your risk capacity. In case this is 1 million I'm investing, if I lose this 1 million, is my life going to be affected? Is my life going to move normal? So if you cannot lose that 1 million and your life continue being normal, then you don't have that risk capacity. So those are some of the things we keep on educating. But with a good education, where a client understands this investment, yes, I can lose maybe 10%, or in case of a good month, I can do like 10% or 5%. But in case of a bad month, yes, the fund manager is there to put a stop loss and all that, and to do the diversification to ensure you don't make the loss. But in case that risk or that risk crystallizes at some point, you understand. So that education is very, very key. So even when you're engaging with any financial advisor or anyone offering you that investment, as an investor, go beyond looking the numbers, go beyond looking the returns, how much you make. Try to understand what are some of the underlying assets, how these underlying assets relate with each other. As he mentioned about the stock market, when you're talking of the stock market, and here you have the fixed income assets, at a different time they will interact at different, when we are looking at this, interest rates are coming down, we are looking at the better valuations on these bonds. So when you're getting into that class, try to understand what is this going to impact on my portfolio. If you're looking on this stock market, we are looking it's a global village whereby any information coming from the US market will impact whatever is happening here. So if there are policies that are being made in different countries, there are wars that are happening, when you hear Ukraine, Russia and all that, what is happening in the commodity market? Is my assets I've invested has underlying asset like a commodity, how is that going to affect me? So that's very the minimum. You should do a bit of a due diligence, try to understand, and then with the time continue diversifying and increasing maybe the risk exposure in your portfolio.